Well, the stock market crash has created a lot of bargains in the market. This week, I will show you 8 stocks to consider. Plus, I will do my regular weekly market analysis. I'll talk a little bit about some upcoming events that we have on Stockscores, some free webinars coming in the next week, and I will do my day trade of the week on NEM. All right, so let's talk about 8 stocks to consider, bargains from the market crash. There are certain things that I look for. I've talked about those criteria in videos that I've made over the last couple of weeks, and you can certainly go back to the Stockscores YouTube channel and look at some of those videos where I discuss my crash reversal pattern. We're going to apply that again this week, but in a little bit different way. I want to apply that pattern to what I would call quality companies, those that are listed in the major market indexes. If they're in, for this week's purpose anyway, if they're in the S&P 500, the Toronto Stock Exchange 60, those are the stocks that I considered this week when searching for my crash reversal pattern. Now I did that because I'm looking for companies that can weather the storm, that can get through this obviously big economic slowdown. Now just because it's in the S&P 500 doesn't mean that it will, but certainly with the number of people that are employed with those companies, the government's going to backstop many of those, and I think that there's just a greater chance that they can survive. So we're looking for companies listed on that major market index, and again this week I'm looking at the TSX 60 or the S&P 500. I want them to have suffered a steep and dramatic price decline through the market crash motivated by COVID-19. Now I'm looking for that crash reversal pattern, and I'll show you this on a chart in just a moment, but we want breaks of downward trends from rising bottoms, and what that all means will be a little bit more clear when I look at a chart. Now, the market is very volatile. These stocks have the potential to have big swings up and down. There is no guarantee that the market has bottomed, and so it's really important that we use responsible risk management and size our positions to reflect the volatility risk that exists in the market. Also, be patient. These things don't necessarily go straight up. It's going to take time. There's going to be lots of volatility in the weeks and months ahead as the economy sort of goes through its recovery process. And we've got a long way until the economy is back to normal. All right, so let's look at some stocks that I like on this particular pattern. And first I want to show you 2 examples of what I call my crash reversal pattern. So this is an intraday chart of JW Nordstrom, and it is a stock that we traded last week in Active Live on Stockscores, and it has the pattern. We've got a downward trend line, a build of a rising bottom, and then a break from the rising bottom. We could also say that Monday morning was a good opportunity to buy the stock, and you can see that the gains it made through the week really reflect that nice recovery that it made. So what are we looking for? Downward trend line, rising bottom, break from a rising bottom. All right, that's the pattern on an intraday chart. This week, we're going to look for it on daily charts. Same pattern, and here's another example. This is Starbucks, and last week it broke its downward trend line on Monday after building a rising bottom, and it's made a good move through the week. I don't think I would want to chase this stock higher. Maybe if it makes another pullback, I would consider it. But this is an example of one that left the station on Monday. We want to look for something that's still relatively fresh, that hasn't gone up a lot. And I've got 8 stocks for you to consider, 4 on the US market and 4 on the Canadian. First up, US stock, United Continental Holdings, basically United Airlines. And you can see the downward trend line was broken on Friday after the formation of a rising bottom. Now we always want to practice good risk management, and that means planning to lose. And for me, if this stock closes below my last inflection point, which is right there at about $21, then I would exit the trade. Now the stock closed on Friday at 31.5, so if we say support is at 21.5 for simplicity, we've got about $10 a share in risk. That means if we buy 10 shares, our risk is about $100, assuming it doesn't gap down through support. And if we then say, well, how much risk am I willing to take? If you're willing to take $200 of risk, then you should be willing to buy 20 shares. If the trade doesn't work, if it falls below that $21 range, then you lose your $200 plus some slippage potentially. Realize it could gap down. It could open one day at 15 and then you take a bigger risk than you planned for. But generally speaking, this is a good method for managing risk. So as I go through the trades for this week, the trade ideas for this week, we're going to talk about where support is so that you can do this risk management calculation based on your risk tolerance. All right, let's go to the next example. It is AIG. You can see the pattern there, breaking the downward trend line from a rising bottom. It did that on Tuesday. It's up a little bit since then, but I don't think it's really run away enough. Wouldn't surprise me if it maybe pulls back a little bit before trying to go higher. Support on this stock is at about $20, so if it were to close below 20, I would think about jumping ship and taking the loss. Next up, TXT. You can see the pattern again. Support in this case is at $24, so if it were to come back and close below $24, I'd say, hey, I'm wrong, get out of the trade, take the small loss. Next up, Disney. Support here is at about $92, $93. You can see it's run up a little bit since the break of the downward trend line on Monday, up maybe 5% since then. I actually think it may pull back early next week, and so you might be able to get it something closer to 100. Keep an eye on that. But for this particular stock, the support is again around 92, 92.50. So use that stop loss point for your risk management. And my first Canadian stock this week is Bank of Montreal. And really all the Canadian banks have a similar pattern, so you could pick whichever one you favor. You can see the rising bottom. You can see the break of the downward trend line on Monday. It's up a little bit since then. Again, may pull back early next week, so you might get it cheaper. Support here is just above $65. Let's call it 65 for simplicity. Number 2 on the Canadian list is PPL, Pembina Pipeline. Some people say Pembina. I'm not really sure what's correct. But you can see the rising bottom, the break of the downward trend line. Support here at about $23.50. Actually, no, we'll go down a little lower, about $21 where I've drawn that green line. Might be just below 21. Third one on the Canadian market is Manulife, MFC. Rising bottom. Let's draw it out here for you. Break of the downward trend line from a rising bottom. Support here at about 15.5. And my final Canadian stock is Aritzia, and you can see it broke higher on Monday from the rising bottom. It's moved up a little bit already. It feels like a bit of a chase, so on this one I'd wait to see if it can pull back a little bit. I think it could easily come back to the $12.50, $13 range near term. But as long as it doesn't go below support at $10, I'm good with it. I think it's a good long-term turnaround chart. All right, so this quick note, we've got some upcoming events on Stockscores or Stockscores events, which you can watch next week. They're free. Live online webinars. I'm going to do one on Saturday, on Tuesday, on Thursday, and then the following Saturday. They're free to attend. If you want to know the topics, all the details, go to stockscores.com. Under the Trader Training menu, select upcoming events, and you can register for those there. And if you're registered, you'll also get a video replay of it in case you need to watch it later on. All right, moving along, let's do my regular weekly market analysis, starting off with the U.S. markets. This is a short-term intraday chart of the S&P 500, and you can see that we broke the downward trend line, and then we did it again early last week from a rising bottom, and that has led to nice gains through the week. We've gone up for 4 days in a row. I think we could maybe see a little bit of a pullback here, but generally speaking, the trend has gone from down to up, and so it looks like a fairly decent short-term outlook for the S&P 500. Long-term chart, here it is, the downward trend line, again broken from the rising bottom this past week. It's maybe gotten a little bit of ahead of itself. Here's the upward trend line now. We could easily pull back a little bit and still be holding that longer term reversal pattern. So don't be surprised if next week we get a little bit of weakness, especially early in the week. Wouldn't surprise me at all. But I do like how things are shaping up for a bottoming process for the overall market. And the Russell 2000, which is our US small caps downward trend line, was broken, rising bottom. There you can see that all happened on Monday. But again, would it be a surprise for it to pull back a little bit first? Not at all. I do like anything that has a good pattern right now, I think is worth considering, but just expect that there's going to be some volatility as the market goes through this process of bottoming. Onto the Canadian markets, and first up, we always take a look at the Toronto Stock Exchange short-term chart, and you can see break of the downward trend line, break again from a rising bottom. So we're slowly grinding our way higher, not running away by any means, but we're stabilizing, we're slowly building that base, and I think that you can slowly start to accumulate stocks that are on sale. Longer term chart, very similar to the S&P 500 chart. It's broken its downward trend line, but it's still going through that process of building rising bottoms. I would be concerned if this upward trend line gets broken, and we have the same sort of line on the other exchanges, the S&P 500, the NASDAQ, the Dow, all of those indexes kind of have a similar pattern. If we start to build falling tops and start to break down through these support levels, then you want to get defensive again. And so we always want to remember that this is not an exact science. We're doing our best to sort of pick our entries. But if the market proves us wrong, if the bottom is not in fact in, we got to step back and get defensive yet again. On the TSX Venture, actually not a bad looking chart here because we've built this rising bottom. We actually broke out late this week. There's some strength in the gold stocks, and I think that's helping. And I'm also seeing some strength in some of the cannabis names. And of course, there's quite a few of those cannabis stocks listed on the TSX Venture. On to currencies. US dollar compressing in volatility. You can see normal volatility is kind of like this. We had huge volatility recently, but that is compressing slowly. And so that does set up for some stability in the US dollar. It's coming back down to normal. I think it's going to come back into this trading range that it was in before the crash began. Canadian dollar really suffering because of the drop in oil prices, but it is starting to stabilize, and I think it's going to start to wind its way higher. As the US dollar stabilizes, the Canadian dollar should come back, and ultimately I think it'll get back to this trading range. It's just going to take a little bit of time. On to interest rates. We always look at the 20-year bond ETF. This is based on US Treasuries. If this is going up, interest rates are going down. So you can see that interest rates have fallen significantly through 2019. And I think that it is a good time to lock in debt. I don't think it's going to get a lot cheaper. In fact, you may see the bond market pull back to its longer-term upward trend line, which would be a pullback into that zone. And that would mean a little bit of a rise in rates. So might not be a bad idea to lock in some debt if you have it. Commodities. Gold made a great surge. I wasn't too enthusiastic about gold just a couple of weeks ago because it really wasn't looking all that great, but it's made a nice bounce back, and now it's at resistance, long-term resistance on the weekly chart. So I expect that gold's going to get stuck here. I do like it long-term. You have to because it's in an upward trend, but it's made a pretty significant jump the last few weeks, so I would be somewhat cautious with chasing gold stocks higher because we do see the spot or the gold price hitting some resistance. Now, it could break out, but most likely it will go sideways for a few weeks at least. Oil prices, can't say the same about oil. It is going in the opposite direction. It is still in a downward trend, and it's really struggling to break it. We're trying to build a rising bottom, and so if we could break next week higher from this rising bottom, well, then I'm going to actually start looking for opportunities in oil names. It's not there yet, but it's something to watch for really closely because the market is trying to break up from that rising bottom. So keep an eye on this. I think there's great opportunity in this sector, but only if we get that break higher from a rising bottom. So something to watch for next week. And finally, the fear chart. VXX is how we gauge fear, and you can see that fear went pretty crazy. We're starting to settle down. If we start to break through this $40 level, then fear is dissipating. I think if we get a little bit of a pullback early next week, you'll see this spike up a bit. And it's okay to maybe be a day trader on that kind of a spike, but I think ultimately fear is going to dissipate. Things are going to stabilize. It may take weeks, maybe even take months, but we're going to get slowly back to normal is my sense from the message of the market. So my ratings then Neutral long-term on US stocks, bullish short-term. They actually made a bit of a nice comeback last week, so short-term traders did well on the long side. Same thing on Canadian stocks. On gold, I'm still long-term bullish. I just think in the short term we're going to get stuck a little bit. That's why I have my short-term rating at neutral. Oil, bearish long-term, but that could change very quickly. Let's watch for a break from the rising bottom. I've got a neutral rating short-term, and that could turn bullish if we get the break from a rising bottom. So stocks continue to stabilize, but we should still expect volatility while the markets recover. Now that's a great opportunity for traders who can take advantage of buying pullbacks and selling into strength. It's the old saying, buy the dips and sell the rips. Avoid decisions motivated by fear and greed. It is very easy to get emotional in this market. We do not want to chase stocks higher. We want to look for stocks as opportunities when they are showing some weakness. Oil is still struggling and it's going to take some time, but we just need that break from a rising bottom, so watch for that. Gold is strong, but it is hitting that ceiling, so I think in the short term we may see it get stuck. Fear is slowly coming down, but we are not without fear still, and so be cautious. All right, so let's look at the day trade of the week, and this again is just an example of a stock that triggered one of my strategy signals in this past week, and this one is from Friday. It is one of those gold names which did really well on Friday. NEM is the stock, and you can see here that it made the action candle right at the open. And what was good about this is that it was not a stock that had gone up a lot the previous day. Most stocks had been surging higher all week, but NEM, Newmont, just came out of nowhere and really started to perform with some abnormal activity first thing in the morning on Friday, or Thursday, I guess. The markets are closed Friday. So we had abnormal volume, we had abnormal price action. That's what makes the action candle trigger. You can see the little pink dot there. The economics of this trade for $100 of risk requires 190 share position, which is about $9,800. But of course, with margin when day trading, you can divide that by 3. And so your actual capital required would be $3,270. It finished the day at an 11 RR gain, which meant for every $100 of risk, there was $1,100 of profit. That is a 33% return on a one-day hold, a great day trade from what is really a great market for day trading. Well, I hope that you've enjoyed this week's Market Minutes. If so, click the like button, leave me a comment, subscribe to the channel, click on the notifications bell, tell your friends, stay inside, do the right thing, and most importantly, trade well.